Welcome back to Investing Talk Podcast. Today, we're taking a deep dive into KULR Technology Group. This is a company that's really navigating an interesting intersection, isn't it? Advanced technology on one hand, and a rather, let's say, unconventional financial strategy on the other. Our mission here is to unpack what they do, how they're actually performing, and, what these unique strategic choices could mean for you, the informed observer. Before we jump in, though, if you find value in these deep dives, please take a moment to subscribe, like, and comment wherever you're listening. It really does help us bring more of these in-depth analyses to you. And if you're feeling extra generous, maybe consider buying us a coffee. We certainly appreciate your support. Okay, so let's get into it. KULR Technology Group, on the surface, they sound like a fascinating tech play, right? Advanced tech. What's your initial take?
Absolutely. I mean, what's fascinating here is how KULR has really carved out a specific niche. We're talking advanced thermal management and energy storage solutions. They're primarily serving some pretty demanding sectors, like aerospace, defense, sophisticated electronics.
Right, critical industries.
Exactly. These are areas where failure isn't really an option, and the demand for cutting-edge solutions is just constant.
So given those demanding sectors, what exactly are their core offerings? I mean, what makes them stand out in that particular space?
Well, they have some proprietary products that really highlight their innovation. For instance, there's SafeCase.
SafeCase.
Yeah, it's designed specifically for lithium-ion battery safety. You think about thermal runaways in batteries. It's a huge issue.
Critical stuff.
Very critical. They also offer things like automated battery cell screening systems, essential for quality control, especially in large battery packs. And then there are specialized materials like fiber thermal interface materials, phase change heat sinks. It's all about getting rid of heat efficiently.
Okay, so a lot of thermal management tech.
Primarily, yes. But they're not stopping there. They've also, interestingly, ventured into AI-powered robotic exoskeletons.
Exoskeletons for workforce applications.
That's right. Which kind of points to a broader vision beyond just thermal stuff. And if you connect this to the bigger picture, their technologies are, well, potentially everywhere. Electric vehicles, large-scale energy storage, the servers powering cloud computing, 5G devices. They're even involved in the safe transport of battery materials for recycling. So they're tackling some fundamental challenges across multiple high-growth areas.
That is a broad and impactful reach, foundational tech, really. But here's where it gets really interesting for me and maybe a bit surprising. KULR has positioned itself as a Bitcoin-first treasury company. So they're holding significant Bitcoin reserves right alongside their cash. That's not your typical tech company playbook, is it?
It absolutely isn't. And it definitely raises important questions about their financial strategy, their risk profile. It's a bold move.
Okay, so let's dig into that. How does this fit with their recent performance? What do the financials look like?
Right, let's look at the context. Their Q1 2025 earnings report, it showed revenue of $2.45 million, which is up about 40% year over year. That's pretty strong growth.
40% is significant.
And product sales specifically saw nearly 89% growth year over year. Even more impressive.
Wow, okay.
Their trailing 12 months revenue, the TTM, also hit an all-time high. That's the third consecutive quarter of record TTM revenue, so there's sustained momentum there over the past year. They even recognized their first Bitcoin mining-related revenue in Q1, about $250,000.
So they're actively mining now, too.
Seems like it. It's a sign of them deepening that involvement in crypto.
That top-line growth sounds incredibly strong, especially, as you said, in product sales. But what about profitability? Because growth is great, but you want it to translate down the line, right, into healthy margin.
And that is where we see a significant red flag. A big one, actually.
Oh.
Their gross margin. It dropped sharply in Q1 2025, down just 8%.
8% from what?
From 29% in Q1 of the previous year.
29 down to 8. Wow, that's steep for a tech company.
It's a serious warning sign. An 8% gross margin means they're barely covering the direct costs of making their products. Only 8 cents left from each dollar of revenue to cover R&D, sales, admin, everything else.
So what caused that drop?
The company attributed it mainly to higher labor costs on technical projects, which raises concerns. Is it cost control? Is it pricing power in the market? Or are they maybe taking on lower margin projects just to drive that top-line revenue number?
Yeah, that makes sense. You'd want to know why. It's a trend that definitely needs watching closely.
For sure.
Okay, 8% gross margin. That's pretty thin. What does this all mean for their bottom line then? Are they actually making money?
No, unfortunately not. For Q1 2025, they reported a net loss of $18.81 million.
18 million.
Yeah, which translates to a loss of 0.07 cents per share. And that loss widened significantly from Q1 2024 when it was $5 million.
So losses are expanding, not shrinking.
Correct. They're not just losing money, they're losing more money. And with those ongoing losses, plus increased operating expenses, their SG&A was up to $7.21 million.
Which covers sales, general admin costs.
Right. Marketing, salaries, the works. So with all that, their free cash flow is almost certainly negative, and the price-to-earnings ratio, it's not meaningful here. They aren't profitable.
Okay, so strong revenue growth, especially products, but really significant margin pressure, widening losses, a complex picture on the income statement. But you mentioned that Bitcoin first angle and their holdings. What about the balance sheet? Cash position, debt. Is that where the good news is?
That is absolutely a clear strength, a crucial distinction for them.
Okay.
They report having over $100 million in combined cash and Bitcoin holdings.
Over 100 million.
Combined, yes. As of March end, they had $27.59 million specifically in cash, plus accounts receivable. And, maybe just as importantly, they report virtually no debt.
No debt. That's quite something for a growing tech company.
It's remarkable. It gives them a huge operational runway. Flexibility to fund growth, weather downturns. It's a cushion many companies with these kinds of losses just don't have.
That capital cushion is certainly impressive, especially with no debt. But how much of that $100 million plus is actually tied up in Bitcoin? And, what kind of volatility does that add for a company whose main job is precision engineering? In fact, some of their recent actions, like that 1-for-8 reverse stock split, that sometimes signals underlying issues, right? Why would they do that?
You're right to connect those. A reverse split, well, it reduces the number of outstanding shares to boost the price per share. Often it's done to meet exchange listing rules, like staying above $1, or sometimes to attract institutional investors who might have minimum price thresholds.
Right. Makes the stock look more substantial, maybe.
Exactly. But while it can look better on paper, these actions often follow periods of, declining share prices. And the market can sometimes see it negatively, like it's an artificial boost, not based on better fundamentals. Doesn't change the company's actual value, just slices the pie differently.
Okay, that makes sense. And then back to that Bitcoin first strategy, how significant is this treasury move really, especially with that $100 million cushion? How is it playing out? Is it a strategic edge or more of a gamble?
Oh, it's definitely significant in their messaging. On June 9th, 2025, they added another 118 Bitcoin. That brought their total to 920 Bitcoin.
920 Bitcoin.
Yes, as part of what they're calling the Bitcoin for Corporations initiative. And their CEO, Michael Moe, was very direct about it. He said, quote, "With over $100 in cash and Bitcoin holdings, we are well capitalized. Our capital market activities are geared to turbocharge our Bitcoin acquisition strategy."
Turbocharge their Bitcoin acquisition. So it's an active strategy, not just holding.
Seems very active. Now, this might really appeal to crypto-focused investors, people who see Bitcoin as, a hedge or a superior asset, but it could definitely concern traditional tech investors, people looking for pure exposure to thermal management or battery tech.
Right. They didn't sign up for Bitcoin speculation.
Precisely. Imagine being a big aerospace client. Do you want your critical supplier playing the crypto markets with your treasury? It adds a layer of, let's say, non-core risk, both reputational and operational.
And it raises questions about capital allocation too, right? Is Bitcoin the best use of that capital versus more R&D or expansion?
That's the key debate. Is this the smartest way to deploy shareholder capital for a tech company?
It certainly adds complexity. A very unique corporate identity forming. How is the market perceiving this blend, cutting-edge tech plus this unconventional finance?
Well, if you look at social media like X, sentiment seems pretty mixed.
Yeah.
You get chatter about the cool tech, the innovations, but also a lot of discussion and maybe some skepticism about the Bitcoin treasury approach. It clearly introduces crypto market volatility risks for shareholders. For some, maybe that's exciting. For others, it's a definite red flag. It probably limits their pool of potential institutional investors to those comfortable with that added layer. Makes them a niche investment in more ways than one.
Okay. So beyond the financial and treasury shifts, any other operational changes happening? Are they streamlining, maybe trying to address those margins?
Yes, actually. They are doing some operational consolidation, often a sign of looking for efficiencies.
Really?
They're shutting down their San Diego lease by November 2025. The plan is to focus operations in Texas.
Ah, consolidating in Texas.
Right. It's positioned as a cost-saving move aimed at long-term efficiency, productivity gains. It suggests they're looking inward, trying to optimize their footprint, streamline processes.
Which seems crucial if your gross margins have fallen to 8%.
Absolutely. It could also signal a strategic focus on certain regions or capabilities based there.
So KULR is innovating, growing revenue, yes, but facing these big margin challenges, widening losses, offset by a strong Bitcoin-heavy balance sheet. And they're making these unique strategic moves. How do they stack up against competitors in their actual tech space?
Well, KULR definitely shines with its proprietary tech, like SafeCase for battery safety. They have strong intellectual property in their specific thermal niche that gives them a real edge there.
Okay.
However, let's be clear. They are still a niche player, a relatively small-cap company. They're up against much larger competitors, companies like Enerseas, A123 Systems. These guys operate at a much larger scale, have a global footprint, generally higher revenues, and more stable margins.
So KULR is more of a challenger?
Definitely more of a challenger. They're trying to carve out a bigger share based on their specific innovations, but they're not an industry leader in terms of scale. Punching above their weight, maybe.
Got it. So looking ahead, what are the potential growth catalysts? What could really propel KULR forward? And conversely, what are the biggest risks we should be watching?
Okay, catalysts. Well, further expansion into AI robotics could be big. Same for the battery testing market. Both are growing fast. And any new significant contracts in aerospace and defense. That's their sweet spot. A major government contract or a partnership with a large EV maker, for instance, that could be a game changer.
Makes sense. And the risks?
They're significant too. First, there's execution risk. Can they actually scale up operations effectively while trying to fix those plunging gross margins? Can they grow without sacrificing even more profit? That's a huge question mark.
Right. The balancing act.
Then, obviously, the volatility tied to their Bitcoin holdings. It exposes shareholders not just to tech sector risks, but also to the wild swings of the crypto market, much less predictable. They also face high R&D costs, which is normal for innovators, but still a drain on cash.
Right.
And the regulatory environment for both advanced batteries and digital assets can change quickly. That adds another layer of uncertainty.
Okay, so we have the innovative tech, strong top-line growth, but serious margin pressure, growing losses, offset by that strong Bitcoin-boosted balance sheet with no debt, plus the reverse split and the unique strategy. Given all that complexity, what's the summary recommendation? How should someone view KULR right now?
Based on everything we're seeing, the recommendation leans towards a hold.
A hold. Why?
Well, you have the strong revenue momentum, and that enviable balance sheet, ample liquidity, no debt that's a definite plus, a real strength. But that sharp decline in gross margins, that raises serious near-term profitability concerns. You can't ignore that 8% figure. And the strategic shift into holding and actively acquiring Bitcoin introduces these non-core risks that just won't align with every investor's goals.
Right. It's not a pure tech play anymore.
Exactly. And that recent reverse stock split, while maybe proactive management, could also signal underlying challenges with the share price and market perception.
So what does this hold really mean for someone following KULR, for you, the listener?
It means watch carefully. Monitor the upcoming quarters really closely for clear signs that those gross margins are recovering. Are labor costs stabilizing? Are they getting better pricing? Before considering, a more aggressive position, you'd want to see consistent improvement on the profit front.
And if things go the other way?
Conversely, if margins deteriorate further or if that Bitcoin strategy starts looking like a major drag, well, then a reassessment would be absolutely crucial. It's a company with, honestly, incredible potential in its core technology. But the financial execution right now, plus that treasury strategy, they just introduce significant complexities and risks.
It is fascinating, isn't it, how a company can be right at the forefront of essential tech like battery safety, thermal management, and at the same time making such a bold, some might say risky, move into digital assets. This dual identity makes KULR a really unique case study. What stands out most to you about this combination?
It really makes you think about the future of corporate treasuries, doesn't it? I mean, as companies look for new ways to optimize their capital, maybe grow it, perhaps we will see more of these unconventional strategies. But it also just highlights that really delicate balance. Pioneering innovation in your core field versus maintaining fundamental financial health. For KULR, it really boils down to a fundamental question. Is their primary business selling advanced thermal solutions? Or are they sort of evolving into an asset management firm that also happens to sell thermal solutions? That distinction, I think, will define their future path.
Indeed. And maybe the question for you, our listener, is this. In an age where even tech companies are exploring these new financial frontiers, what's ultimately the most valuable asset for a business to hold? Is it that groundbreaking patent? Or is it a robust crypto reserve? Something to ponder as you navigate your own understanding of today's market. We hope this deep dive into KULR Technology Group has given you plenty to think about. Join us next time on Investing Talk Podcast for another in-depth look at what matters.